Hi, today was a crazy day in the equity markets, really crazy, but I want to talk about soybeans. So I see a bearish setup in soybeans, and okay, let's go through this. So, first of all, this closed yesterday below the 8 EMA, which is the orange line. See it closed down here, so that's bearish. And then today it gapped down. And you'll notice that there's no wick on the top of this candle, today's candle. There's no wick, which means it just started dropping right from where it opened and never went higher. That's a bearish sign. So the close below the 8, the gap, the no top wick, those are all bearish. Also, you can see this yellow line. There's been a trend line that goes, I have drawn back to before October, I guess into September, which has been tested several times, and we finally broke through it today. This is almost a head and shoulders, but it's really ugly, and there's this previous curve. So it's really pretty far from a head and shoulders, but it's kind of a similar look to it. And we closed below, so that would be called a neckline if this was a head and shoulders. But anyway, we closed below it, so that's bearish. And we're actually below all the moving averages that I have on my chart. I have from a 3 exponential moving average all the way up to a 200 simple moving average, and we're below all of them, so that's bearish. And when this bounced, when price bounced off of the trend line and went up, it couldn't even make it to the 382. See, this is the 382% Fibonacci retracement level from the bottom here to the top here. So that's bearish. It should have been able to make it up to the 50, if not the 618. And the 382 would be a minimum, and it didn't even make it that far. So that's very bearish. Let's see. This ascending wedge here, or channel, was broken, comes down, tests the trend line, comes back up, and retests that same channel, and then rejects it and bounces off it. That's a beautiful pattern. That's a pretty reliable strong pattern. When you break out of a channel, go back up and test it and drop down below and keep going, that's fantastic for a short. Excuse me. So we had that. The light blue line is the Bollinger Bands, and the darker blue line, excuse me, is the Keltner channel. And when the Bollinger Band comes inside the Keltner channel, like it does here and here, and then breaks back out of it, that's called a squeeze breakout. So I call it a BBKC for Bollinger Band and Keltner Channel breakout. So it hasn't quite broken out yet. Like the blue or light blue Bollinger Bands have not quite yet come outside, back outside the Keltner Channel, but it's just about to. Could not be closer. They're practically, well, they're touching down here, and they're very close to touching up here. So one more down candle, and that will probably turn into a breakout. And when you have a breakout, price will continue to move in the direction that it's breaking out, but for at least like 5 to 7 candles worth. So that's looking very good for us. That supports a short. The stochastics are still mid-range. Below 20 would be oversold, and the faster, actually that's the slower period, right? Yeah, the slower stochastics is just barely below 20, and the faster stochastics is not even close yet. So there's a lot of room before it becomes oversold is the point. So we got room to short it. The ABCD is, so if you measure from the top down to here, copy this, you get a retracement, and then that same line, same length, you extend out from here as a projected target, right? So that's going to coincide with the 61.8% Fibonacci extension. So the fib range, again, it's from here to this low to this high, and beginning 0 on the bottom. So this is a minus 27.2%, which is a common target also, but I'm shooting for the 61.8, which is also a common target. A little more ambitious, but it lines up with the ABCD measurement also. So I think there's a good chance they're going to hit it. So because of this gap, and there's a chance that price is going to come up and try to fill in this gap. It could happen much later, or it could happen right away. But I don't want to get in this trade with this coming up against me trying to fill in that gap. So what I'm going to do is I'm going to use a sell stop limit entry order. So what that says is price has to come down and trigger this order at this price level, which is 866.5, which is about half a point below the low of this candle. So if when this reopens again 8 o'clock tonight, if it starts going up, we won't be in it. We won't have to take that heat because it will not have triggered our order. It won't trigger it until it comes down below this level. And there's also, when you use a stop entry, there's a chance that you're going to have a big gap down and it'll just fill wherever that big gap is, which could be much lower than you expected, and then it could start up and cause troubles. So when I use a stop order, I like to use a stop limit order, which says how low I'm willing to go on that price. So that I'm using a stop limit order of 860, excuse me, 866 as the limit. So the trigger is 866.5, but I'm saying I won't short it if it's below 866. So that gives us a half a point slippage, which is acceptable on this contract. Okay, so that's a stop limit. If you're not familiar with a stop limit order, you should check that out. It's very useful. And for a stop, again, there's a chance it's going to come up and fill in this gap. And so I have to put my stop sufficiently high enough above that so it doesn't get hit while it's filling in this gap. Now this is the 8 EMA. If things go the way they should and it comes up and fills in this gap, it's not going to go up much higher than the 8 EMA or the top of the gap. So I put the stop loss up here, and I also checked another thing. I didn't put it on the chart, but I calculated what a 61.8% fib retracement would be from the bottom of this candle to the top of this candle, so this range. And I made sure that my stop loss, which I set at 900, is higher than the 61.8% retracement, which is 895. As another way to protect from our stop loss needlessly being hit. Okay, and let's take a look at the risk reward. So from my 900 stop to the entry, which is 866, that's 34 soybean points. Now the reward, if I enter at 866 and it goes down to our target, which is 827, that's 39 soybean points. Each point is worth $50, and the reward is larger than the risk, but not by much. It's pretty close to 1-to-1, but this looks like a very probable setup, so I'm going to tolerate only slightly greater than a 1-to-1 risk-reward ratio. I'd rather have 2-to-1 or 3-to-1, but on the other hand, if you have a high probability setup, then 1-to-1 is warranted. Okay, so looking forward to seeing how this goes. Hope it turns out as well as the soybean meal trade. That turned out fantastic. You can see that on the block. Okay, well, good luck to us. Thanks.